Hi, this is Randy Finney with the Right Side of the Chart, and today is Tuesday, February 25th, 2014. And I'd like to do a video overview of the broad markets and some of the key sectors today. My posts have been relatively light, well, actually very light. Most of you who followed the site for a while, my the average updates on trade ideas, market analysis. In other words, each post that I make, I'd say averages normally, several per day. And lately, over the last week or so, I've only been posting maybe a post a day. And most of those have been focused on closing out existing positions. I have not really put much effort into looking for new setups, and that's reflective in a couple things. Number one was my outlook for the broad markets over the last few weeks. We nailed that move down on the short side. I had a high degree of confidence the markets were going to pull back 5%. And we did. We moved down a little bit, overshot my downside target just slightly. I think the broad markets, the S&P dropped about 6% or so, if I recall. And at that point, I closed out a lot of short exposure, took some long hedging exposure for the bounce. And the bounce, admittedly did exceed my upside targets. But again, as I stated at the time, my degree of confidence wasn't very high at that point. So really what I've done is, and as a trader, you need to do this from time to time, is just step back, book some profits, and I've waited for the dust to settle and for the charts to become a little bit more clear, or at least the way I see them. And I think we're getting to that point now. It looks to me, for the first time in a while, I'm starting to see, that the risk reward is skewed at this point more to the short side. I think it looks we might see some objective short entries here in both the broad markets and some individual sectors. So let's go ahead and dig into those charts. We're looking at the live chart links page here. Most of you are familiar. This is the main menu for right side of the chart up top. And if you click on this box here, it brings you to the live charts where we're already at. So these are the index charts. I'll go ahead and update these today. Most of these are already up to date, I should say, as well as the gold stocks. I updated those last week. Many of these trades have already hit one or more profit targets. Some of these have actually hit the final target, and I just need to get around to archiving, printing up a static chart, mocking that up, and then posting those, and I'll remove the trades that have hit final targets. But the remainder and the bulk of these trades, these are long-term trade ideas. Again, the gold stocks were and remain one of my favorite picks, if not my top sector for 2014. But at this point in time, we've run up. We've hit, the second target on GDX, and a lot of these individual gold stocks at that same time hit my individual price targets, second, third, in some cases fourth profit target, and in which case those trades will be closed out. Or at the very least, those that have hit intermediate price targets, I'm looking for or would like to see a pullback or a consolidation before getting back into the sector. So, at this point in time, I have virtually nil, very little exposure to the gold and silver mining stocks, booked most profits over the last week. The broad markets, I am at this point interested in starting to aggressively add back some short exposure. In fact, I started that yesterday and will continue to do so today. So let's take a look at the charts, and we'll start out with the Nasdaq 100 here. Okay, bear with me, folks. I'm trying to center this. Okay, there, I think we have it. All right, this is the NDX. Again, all the charts that I'll talk about today are available through that live links page. The NDX, the Nasdaq 100. What I've had to do here is resize the live charts from the stockcharts.com page down to fit the video size for the YouTube videos here that I'm using. So essentially, I've compressed the chart, which makes these annotation boxes overlap. Everything's a little bit out of place. So again, when you visit the live chart links, you'll see the chart in its full size, and everything will look a little more clear. Now, what we've had since this last breakdown here, we had a breakdown of this uptrend line, this white uptrend line where the crosshairs are. Breakdown, a very impulsive move down. That was a move that we caught on the short side. And this is where the markets hit that second target, final downside, initial downside target, I should say. We've come back up to back test, and I believe I posted some static charts here a week or two ago. We've been back testing now for a good week or so, crawling up underneath that trend line. And again, this trend line has not been modified in a long time, so it just shows that the markets are respecting that trend line. You know, we had the breakdown, the very impulsive move, which that in itself helps validate the trend line, which was created, of course, off all these reaction points here. But when you see a breakdown and then in the impulsive selling, it helps to validate it. And we've come back up and stopped cold, have back tested beneath that trend line since. Now, on this move higher, you know, I'm sure a lot of bulls are clamoring, oh, well, we broke out to new highs. That's a bullish event. And on face value, it is. I'm not going to take that from the markets. You know, new highs are always bullish, just on face value. But what I'm looking at are the indicators here. We have the RSI up top. If you notice the RSI peaking here at this point and now making a much lower high while the markets are making a higher high. Same with the MACD down here. We have, again, which is called negative divergence. So these indicators are making lower highs while the markets have made higher highs, i.e. negative divergence. You can see the MACD is starting to curl down. Once this green line on the MACD crosses over the signal line, the green line crosses down below the red line. If that happens soon, we'll have confirmed negative divergence. I do like to see the MACD roll back over and especially see that bearish crossover down here. So right now we have, well, I'll call it potential negative divergence, but the fact that we do have that divergence forming, we do have the back test here. Overall, I view that as, you know, bearish development. I do see more downside and still maintain these downside targets and believe that in the upcoming months here, sometime maybe in the second quarter, no later than the third quarter of this year, we'll probably see this blue longer-term uptrend line hit. This blue uptrend line goes back quite a while, and this is really the primary uptrend line here for the Nasdaq 100. So either way, I think scaling into shorts, if you are, you know, of the bearish persuasion here, and you think that the markets are looking a little toppy and due for a pullback, like I am, I think adding back short exposure at this point in time with the appropriate stops above makes sense. This is the Nasdaq Composite. You know, again, these boxes have been shifted around a little bit, but on the last update, at least on the live charts back on January 24th, prices were above this yellow, what I call minor uptrend line, and I stated that a break below that minor uptrend line would likely bring prices to this larger, more important uptrend line, which really defines a channel. If you look at the white uptrend line here and this white uptrend line, you have this ascending channel. And I stated that a break below that yellow uptrend line would likely bring prices to either this uptrend line or this T1 level. And as you can see here, we did hit that first uptrend line, and that's where the market's bounced. So far, you know, this bounce is perfectly normal. The fact that we've made marginal new highs, if I saw the RSI, the MACD, and some other momentum indicators and oscillators, you know, going on to make higher highs as well, I would chalk that up to be a more bullish, longer term event. But to see a marginal new high, especially if prices do turn down, and we see the MACD roll over here soon, my guess is that we're heading down, and we'll eventually take out this. The lows put in about a month or so ago and continue down to these lower price targets. And here on the NASDAQ, I wouldn't be surprised to see this T3 third target level eventually get hit in the upcoming months. Okay, this is the Russell 2000 index, and what we had here is a breakdown of this large rising wedge pattern. Once prices broke down below the lower uptrend line, we had some consolidation in this area, and that looks like a nice bear flag. You can see the pole here a bear flag pattern, which is a continuation pattern, and then a breakdown, which measures roughly the length of that pole there. So that's textbook technical analysis right here. You know, a breakdown of this larger uptrend line, consolidation below there, and then a quick and sharp move down, just like the initial move down on the bear flag, and to hit that first support level that I had there. S1, for those of you not familiar with my shorthand annotations, S1 would be first support level, S2 the second support level, and those are usually minor support levels. I'll put the price targets, such as T1, as a more major support level where I expect a more lasting reaction or bounce. R1 would be resistance, so overhead we might have R1, R2. So this is a Russell 2000. Large, long-standing negative divergences on this bearish rising wedge pattern. If you look here, down here at the MACD, up above at the RSI, and as you can see, prices have continued to wedge higher, making higher highs, while the indicators and oscillators are making lower highs, and that is negative divergence. And this is just, you know, beautiful display of technical analysis here again with that bear flag pattern hitting this S1 level. These lines have been here for months now, so we hit that first support level. You know, pretty, again, the magnitude of the bounce did surprise me somewhat. I'm not shocked by any means, but I didn't expect this to go at that high. You know, although take that back, about a month or two ago, before we even broke down, or right as we're breaking down, I did mention the possibility of a higher level back test of these trend lines. Again, there's infinite number of scenarios, but that's one that I did have reserved as a, you know, as the most bullish scenario, I think, at the time I stated. And that's exactly what's happened. So we're seeing a lot of back tests beneath these recently broken long standing uptrend lines, and that is why I believe we're looking at a pretty objective, you know, shorting opportunity here. With the appropriate stops in place, because I do expect prices to roll over soon and continue down and take out these recent, look like late January lows. Okay, let me try to speed things up a little bit here. This is the S&P 500, and essentially we had the breakdown here of the large rising wedge pattern defined by this white trend line and this uppermost trend line here. Prices did break down, and again, I was really focused, if you recall, in January on the 120-minute or 2-hour chart of the SPY and the S&P 500, and that's where we hit and then just slightly overshot my downside target, which was S2 on there. So the initial move down went down as far as I expected. We bounced a little bit more. Surprisingly, although this isn't the most well-defined uptrend line. If you look, we have 1, 2, 3. We actually pierced through that level there. So this uptrend line could probably be modified a few different ways, but we've shot up through it. And again, this plays into the fact that my degree of confidence hasn't been very high, and that's why I've stepped back a little and I'm just watching the market action here, because we did, in the case of the S&P, we've actually overshot a back test. But again, this line, you know, on a scale 1 to 10, I'd probably give this a 6 as far as how solid of a trend line that is. This yellow trend line, this goes back much longer. This is a primary uptrend line, which I do think over time, you know, this will continue to rise. I think this is a likely target to be hit in sometime this year, sometime in 2014, second, maybe third quarter. And at that point, it'll probably come in with this T1 or T2 level. Of course, that yellow trend line keeps rising, if you will. And this is the first and second and currently final downside target I have for the S&P this year. Like everything else, divergence continues. The S&P just eked out a marginal new high yesterday, I believe it was, and with the RSI, the MACD, just about all indicators and oscillators continuing to diverge. So that is one reason I do think we have more downside to come. Okay, this is the XRT, the S&P Retail Index, so the retail ETF, and we did good. You know, this one, gosh, I pointed this out as a short candidate, in many of the stocks in the retail sector back here. I had dual trend lines I was watching. This white trend line in which we had a breakdown and a back test, and then this yellow uptrend line, which was really the final straw. You could draw trend lines off both of these because you had various reaction lows to draw those off of. Either way, that again, you can revisit those posts, the notes on here. But what's happened since, we had a nice healthy correction in the retail sector, and that was clearly laid out in the charts, in my opinion, with all the divergences in place and everything. We slightly exceeded my second target, and I had this other support line under there, hammered right off that, and we bounced back. Now the retail stocks have made a nice bounce since hammering off that lowest support level I've had on this chart, and look where we're back to, T1. Remember, in technical analysis, support once broken then becomes resistance. So we broke this, we hit T1 way back here, bounced, consolidated a little, and then fell sharply, moved down to the T2 level, and now we've come back up. This T1 is now resistance. So this kind of goes in place. We're not doing a full back test because the retail sector had such a correction and got so far away from these uptrend lines. A back test is probably not going to happen at this point unless these things will just power up forever, and at that point the back test would be so much higher. Anyways, I'm digressing, but we're as most other sectors and as well as the broad markets are backtesting key uptrend line breaks. We have the retail stocks backtesting a resistance area, so that's one to watch. And I can't comment on. I'd have to look at the individual retail stocks. I plan to dig back into the charts this week and look for some new trade candidates, both on the long and short side. And I'll look at some of those retail stocks that we recently traded that hit profit targets, and maybe we have some of those bouncing back to resistance as well, which wouldn't surprise me. This is XLE, the energy sector ETF. Same story as many others right now. We had a large rising wedge pattern. This one had a very well-defined trend line. Just look at all the reactions. 1, 2, 3, almost 4, 5, 6, almost 7, 8, 9, and then finally the breakdown and back test. So, in technical analysis, it doesn't get much better than this. You have a back test, you have these, highs, which may act as resistance. Wouldn't surprise me to see a slight overshoot, maybe a marginal new high in the sector, but I'm not banking on it. We have nice divergence in place that preceded the breakdown of this rising wedge pattern, and we still have divergence. Even if these stocks were to eke out a new high, we still have long-standing negative divergence in place on the energy sector. So, this is one of my favorite short sectors for the foreseeing upcoming weeks to months here, and there's a few individual, I believe Chevron, Texaco, ExxonMobil, and there might be a couple other individual energy stocks on as trade ideas. This is XLF, the financial sector ETF. Here's another well-defined trend line, this white uptrend line. Another bearish rising wedge pattern. I just have the upper part of the wedge drawn in here with an orange color trend line, but that shows the divergences in place. Keep in mind, I've had this question put to me, what defines divergences? You look at the uppermost trend line on rising chart patterns with prices rising. You look at the uppermost trend line when you're looking at a wedge, for example, and vice versa on a downtrend. If this were a downtrending stock or ETF, and I had a bearish rising wedge, you'd look at the lower trend line and compare that against the indicators and oscillators here. So this is negative divergence, and like everything else, a breakdown and a retest. I have this dotted. This is I believe to be a significant support line here. So if the financials were to pull back down here, which I do think is very likely, currently that's around the 2050 area. Watch for a breakdown of this line, or at the very least in trading, if this is a support level, you'd want to be shorting here with a stop not too far, maybe over the recent highs. But if prices were to come back down here, let's say you don't short or you plan on adding on, you don't want to add right above support. You want to either wait till that support breaks to add onto your position. Just not either, just that's what you want to do, is not add right before support. Just wait for a breakdown, assuming that you either added here, maybe a half a position, add the second half down here, or if you didn't do anything and you get down to that point, you might as well just wait. But again, trading isn't so simple. You take this into account with all the other the broad markets, look at other sectors. What I mean by that is if, let's say, XLF does go on to break down and has a nice break of this minor uptrend line here. I'll also look at the S&P 500, the Nasdaq, other individual stocks within the XLF, such as JP Morgan, some of the big companies, Bank of America. And if those stocks or a lot of the other broad markets or even some other sectors are all coming up or approaching support and the XLF broke down below this trend line, I wouldn't add to my position then. So in trading, whether it's an individual stock or a sector, always keep an eye on the broad markets as well. Because you don't want to short a breakdown on an individual stock or a sector if the broad markets, the bigger picture, are coming to right at support, or they may have a shorter term bullish chart. Maybe the 60-minute charts look bullish. So hope that makes sense there. This is the XLK, the technology sector ETF SPDR. Same story. Well, a little bit different chart, I should say. Not same story. We don't have the same breakdown and back test as we do on some of the other ones. We did have a minor uptrend line here. We broke down, back tested, came up a little higher, and then fell sharply. But the important thing that I see on this chart is negative divergence here. Prices in the tech sector have recently made new highs. While we have significant divergences in place. We had divergences leading up to this initial move down, longer standing divergences, these white lines here. And now in this recent push higher, as convincing and impulsive as that has been, the indicators and oscillators are severely lagging. So again, yes, we need to be cautious because we have prices at new highs here. But my take is that this is not a sustainable breakout. I don't think we're going to see prices power up. And if we do see these divergences burn through and prices continue to move up, then my outlook will have to change. So right now it remains bearish, and I think we might have some good shorting ops here. Okay, last chart, and we'll wrap this up. This is the GDX. Again, this was one of my most active sectors, both personally and the post on the site. A lot of talk about the gold mining stocks, and as mentioned recently, they hit on the daily chart one of my key target levels, so I booked a lot of profits. And I pointed out this bearish rising wedge the other day. This is a 60-minute chart we're looking at, and I wanted to just talk on this real quick, because as I talk here. It's what is it? About 10:40 Eastern time today on Tuesday. We're just now seeing prices start to slip below here. Let's zoom in a little bit. As you can see here, we're starting to crack below that wedge. I will say this isn't the most well-defined rising wedge pattern. We do have, I could draw this upper line like this, and we still have divergence there. Either way, we only have a couple. 1, 2, now 3 reactions here. However, prices are wedging, so the spirit of the pattern is there. It would be nice to see a few more touches on this lower trend line. But again, I take this 60-minute chart in context with the daily chart, which I've shown. We've hit that second target zone there. And now we have a bearish rising wedge pattern, clear negative divergences on the 60 minutes with prices at resistance on the daily chart, not to mention one heck of a run with very little pullback. So in the daily time frame, these stocks, the gold stocks, are very overbought. And again, I remain longer term bullish on these for now, but near term bearish, looking for a pullback or at least a consolidation. So even if we just consolidate, even if we pull back to my earliest target, which would be here roughly the 2475 area, as well as this trend line, I had listed 3 targets: this uppermost trend line, this uptrend line, this uppermost horizontal level, this uptrend line, and then the 20, we'll call it the 24-ish area. Even if we only come back to there, that's still a decent pullback. We're talking, nearly 2 points from where I mentioned the stocks the other day. I think they were up here, yeah, about 2 points higher on a $25 stock. That's a pretty decent pullback there. So I'd like to see the gold stocks come in here. I'd love to see them get up to this support line here. You see a lot of support. Here's a long volume at price histogram bar. This would be a good place to start adding back exposure if we get that pullback in the mining stock. So, okay, I hope this has helped. This has been Randy Finney with Right Side of the Chart, and have a great day.